All right, another supply and demand strategy lesson today on my YouTube channel. Welcome back, everyone. And I'm extremely excited about today's lesson. So please take out your notepad, your pens, because we are going to cover one of the most important lessons there is. In fact, what I'm going to explain is the most important supply and demand rule there is. And if I had, and I'm not kidding, if I had only one rule to choose in terms of supply and demand that I can use for the rest of my life, if I really had to choose only one rule, that would be the rule that is by far the most important rule. All right? So without further ado, I'll explain the most important supply and demand strategy rule today. I'm going to explain first the theory on the slides that I've prepared for you. And then I'll jump right into a practical application session where I translate the theory into the charts. All right? Now, just a small recap, because that rule, that specific rule, ties back to our first step of our three-step mechanical process, which is location. Remember, how do we determine location? We determine location on the higher time frame, not on the lower time frame, because we use lower time frame only for the zoning process. We use higher time frame for our location and for our direction for the trend, which we start covering in the next lesson. So there are two reasons basically why we need to define location. And the first reason we discussed already last time. Again, remember, this is really to quantify whether we are low on the location, so whether current price is cheap, or whether current price is expensive, or whether current price is basically in equilibrium, meaning for us, well, the chart right now is useless. And remember, now imagine this is our higher time frame chart. What are the three steps? We first identify supply on the higher time frame, and then we identify demand on the higher time frame, and then we split the area into three equal parts. So we get an area that is basically high, or in other words, expensive and very expensive. We get an area that is low, or in other words, cheap or very cheap. And then we get an area that is equilibrium. So for us, it's no man's land, where we don't want to engage in price. And if basically current price was in equilibrium, so somewhere here, then we would not want to either short, or we would not want to also not go long. And equally, and we're going to talk about this in a second, even if we can find a supply zone here, so this would be basically, if you zoom in, you go to the lower time frame and you find a supply zone here, and if you know that this area is equilibrium, you would not want to engage or short in this supply zone, even if this supply zone is high quality. We talk about the zone qualifiers in another session. Even if the zone is high quality, you would not want to engage in this trade because it's in equilibrium. So now basically, let's assume, and this is what you would do as a first step, identify your higher time frame zones to understand location of current price. Now here, current price is, you see that, is in the lower area, so price is, so that's how we can quantify price is low. So buy low, sell high, that we can, using location, we can finally determine and say, hey, what does it mean buy low, sell high? Exactly, that's what location is for. Now, also very important that you please note down, it doesn't mean that although price is low, it doesn't mean that we going to buy for sure. It just means our rules allow us that we are looking to buy. And the same thing if price is high, expensive, or very expensive. It doesn't necessarily mean that we going too short. It just means our rules allow us to look to shorts. There are way more rules to it. But also, when current price is in equilibrium, it tells us we are not going to touch this market. Now, that's what location is for. Now imagine, now this would be the second step, right? We have identified location, and the second step would be then, well, I'm skipping the real second step. The real second step would be you identify your direction, in other words, your trend. We're going to discuss this next week. So the next step would be then identify lower time frame zones to understand location of your zones. So now imagine, and this is what we are now discussing now, your lower time frame zone. You would zoom in, you would go to the lower time frame, and you would find a zone which would be here highlighted, right? Imagine you would have zoomed in and you find a zone in this higher time frame chop base rally that is covered by the higher time frame zone. And this is what I call big brother, small brother principle. And this big brother, small brother principle is the most important rule there is. Meaning, in other words, trading covered by the higher time frame. Metaphorically speaking, let's assume you are, to explain this concept further, let's assume you are a 14-year-old teenager and you get into a fight with another 14-year-old teenager. Who is going to win? Well, it's a 50-50 chance in terms of odds, in terms of probability. You guys are the same age. But now, if I get into a fight with another 14-year-old, so let's assume I'm the 14-year-old, well, I'll get my bigger brother to the fight as well, who is 21, who does martial arts, who is a big dude. So now, and I'll ask him to support me in the fight, to protect me, in other words. So who do you think is going to win the fight now? So the probability increases tremendously and is now on my side because I brought my big brother. And this is exactly the concept here. If you find a zone, a lower time frame zone, that is covered by the higher time frame zone, so you are now trading, and this is, I think, mentioned here, high probability trade as two forces. Now, two forces, the higher time frame zone, so the big brother, and the lower time frame zone, the small brother, push in one and the same direction. Remember, the higher the time frame, the bigger the imbalance, the more unfilled order, the higher the probability of a successful trade. So push in one direction against one force on the lower time frame. Because if the next higher time frame zone is only up here, conceptually speaking, you would now have a profit margin, or in other words here, a risk to reward proposition all the way to the next higher time frame zone. Obviously, this doesn't incorporate trend, direction, etc. But just conceptually speaking, if you trade covered, if that rule, big brother, small brother principle is met, if your lower time frame zone is covered by the higher time frame zone, well, then you're trading with the force, with the probability of the higher time frame zone. And now, if you go to a lower time frame and you see some opposing zones, supply zones on the way, well, you could, conceptually speaking, disregard these lower time frame opposing zones because you are trading with the strength of the higher time frame zone. Now a question that I get, and I want to already cover that quickly here, a question that I get all the time is, why is the zone on the lower time frame not holding? It is covered by the higher time frame. Again, we are speaking always, first of all, in probabilities. Nothing is 100% for certain. But there might be some reasons why you even if you trade covered, the zone is not holding. Because both zones, big and small brother, must be of high quality to support each other. This is also really important. And again, what does high quality? Again, we need to, and this is really important, we need to really quantify everything we are doing. We have to put rules to everything we are doing. And we will talk about quality, so zone qualifiers, where we can quantify the quality of a zone later on in this course. But now for you, it's really important that, for now, conceptually speaking, that if the big brother and the small brother is high quality, then you increase your odds as well. And if they are not high quality, obviously you decrease your odds. And if higher time frame zones are wrongly identified, and this, I see this usually with beginners, they think they mark the right zones, but they are not correctly identified, then the complete dynamic of location analysis changes, right? I mean, for instance, previous identified demand zone in lower time frame might be now located in equilibrium. I mean, there could be a lot of things wrongly identified if you're a beginner and you don't have all the rules, if you don't know all the rules, or if you just simply are not capable to really highlight high quality zones. And what we start obviously incorporating next time is direction. If we go against the trend, there's also a higher possibility to get stopped out. So first and foremost, you have to make sure that both zones, ideally big and small brother, so higher time frame and lower time frame, are high quality. And then obviously you have to practice and you have to make sure that you identify these zones correctly, because if you don't do, you might be in a completely different context that you actually are. And now we're gonna go into the charts, and I'm gonna show you how I would now do that. Now remember, on the Swiss franc futures, and I kept that on purpose because we're gonna continue here the analysis, and I'll show you how I would do now the big brother, small brother principle here. Now, I want to stress, once you are more advanced, you will not need to split the whole area into multiple parts and have to write down, hey, this is equilibrium, expensive, cheap. You will know that if you are more advanced supply and demand trader. This is just really to visualize for the beginner trader, to know whether they are expensive, cheap, equilibrium, etc. And I'll show you also today how I would do it as a let me call it very advanced supply and demand trader. Now we are again on the weekly chart, and as you see, we are basically, you see, price is moving already from that very expensive area. So what I would do now, again, if I had to now start over, so if I had to classify demand, I would first, well, I could classify first supply, doesn't matter, right? We have to do anyway both. I would just say, okay, I see here is demand. I say also, and we highlighted both zones, it's here is demand, higher time frame demand on the weekly chart. So you see they're basically overlapping, which is really important, because for me now, because if price comes down here or even here, both of it would be cheap or very cheap because we are covered by higher time frame demand down here. And if we look for supply, you see this supply, this drop-based drop, is already tested way more than 25%. So price basically reacting from that drop-based drop. So I would go up here, and for me, clearly, you could, yes, as we did here, you could, by the way, I'm highlighting here for me in my rules, more advanced rules, I just highlight the wider version versus here I just did the preferred version. But again, if you split the area into 5 parts, you see the cheap area is part of the wider version here as well. Now, if I go up here, yes, the wider version of that is here, this area. But also here I would say, because you have that rally base drop, it's a clear U shape, but hey, where is the basic candle? So you see here I don't have necessarily a basic candle based on our set of rules, but you see there's a long wick and a also big body. So I would basically say, okay, apply here my rules. Everything that looks like a level is a level. So I would highlight the entire area as a zone here as well. Almost like, well, what we also learn later, a level on top of a level scenario. All right. So you see now, for me now, very simple. This is the way how you would do it as a beginner. This is how you would do it if you're already more advanced and you know you can also pick high quality zones. All the way down here, I'm allowed to look to buy and I look for demand. All the way up here, I'm allowed to look to sell, to look for lower time frame supply. So what I would do now, obviously this is my higher time frame. I would go now here to the daily chart. And on that daily chart, you see, I'm allowed in this area from here proximal to distal line, I am looking for a lower time frame zone where I can find basically the imbalance in the imbalance, the small brother of the big brother. And you see here already, I have here a rally, base, drop, followed by another drop, base, drop. So here, I have a very nice inverted U shape, rally, base, drop, that I also highlight now here in a different color. Again, I can make it any color. Let's make it green. And now I go back to my weekly chart. So what you see here now is I refined my higher time frame weekly chart. And I found an imbalance, a smaller imbalance of the big weekly imbalance. So my big brother, small brother rule is met. So now if I go all the way up here, if price comes all the way into the zone, here starting here, I'm not going to short here because I wait for price to go into my higher time, my lower time frame, high quality. This was high quality, by the way, but we're going to discuss this in the upcoming sessions. I'm going to short that lower time frame supply here because this is my small brother. The green area is my small brother. The yellow area is my big brother. So I'm trading with the force, conceptually speaking, with the force of the big brother. So my profit margin or my risk to reward proposition would be all the way for now until here. All right. And we could do literally the same thing for demand. If price comes down here, we would need in this whole area, we would look for a lower time frame, high quality demand zone. And then this high quality, lower time frame demand zone is the one that you would be allowed to take. All right, this is the zone that you would be allowed to take. I mean, I could quickly do that. I heard that you liked these these practical application session. So down here we can see, well, there's a lot of zones down here, but just from a conceptual point of view, you see here's a zone, here is a zone, but also here is a zone. So this is called level on top of level. And this is another rule that is really important, but we're going to discuss this also in another session. But you could now say, I have here a level that I highlight in green again. Now I go back to the weekly. And you see, you refine the whole, this big weekly area, you refine that big weekly area, and you found a small brother in that weekly higher time frame location area. So if price comes all the way down here, if price comes from here all the way down here, this would be the area that you are basically refined the weekly, where you have now a lot of profit margin, or in other words, risk to reward proposition to the upside. All right, so that's the rule, the big brother, small brother principle. That rule that I always have to, it's my first rule, I always have to be covered by the higher time frame. You could do that, you could say, as a quote-unquote day trader, you could use, as a higher time frame, you could use the daily chart, and then you could say my lower time frame is the 4-hour chart. So your 4-hour chart has to be covered by the daily chart, right? So higher time frame, lower time frame, we talked about this. So that's the most important rule there is. That's always the rule that I'm looking for. If I do market timing, I have to be covered. There's no way around, and this should also be your this should also be your rule. That is the most important rule for you when you trade supply and demand. All right, let me know how you enjoyed this session, if you knew about big brother, small brother principle, if I am the first one who teaches you big brother, small brother principle. And please like the video, engage in the comment section, it's really important. And yes, thank you so much for watching until the end. Until next Friday for another supply and demand lesson. Bye bye.